It is a wonderful honor to welcome Carola Binder to the podcast. She is the Associate Professor of Economics at Haverford College. And in this hour, we are discussing her new book, Shock Values, Prices and Inflation in American Democracy. Carola, welcome to the show. How are you?
Thanks a lot for having me. I'm doing good.
Yes. So the book is a fantastic account of monetary policy, price controls, and inflation across American history. Economics is a fairly new field um, for me. It's not one that I claim some expertise in, but I'm doing my master's on the election of 1896, in
Oh,
which the central issue is money, or
great.
specifically what kind of metal is suitable to use for backing money. I understand that in William Jennings Bryan, the Democratic nominee, was representative of the movement known as Free Silver. So
Right.
please explain to us the importance of this movement or where it came from and its significance.
Sure. So it's important to know that the US was on a bimetallic standard for a lot of US history. That means that um, so the dollar had to be convertible to both silver and gold at fixed rates. And if you have a bimetallic standard, then there's like a fixed exchange rate between gold and silver, essentially. Um, Now, during the progressive era, so like in the around 1896, um, William Jennings Bryan and others, they really wanted what we would now call monetary expansion. So they wanted like looser monetary policy, and they wanted this by making like allowing silver again to be a money. They also wanted, some of them wanted greenbacks to be money again. So greenbacks were paper money, what was issued during the Civil War, but had been withdrawn after the Civil War. So they wanted not just gold, which would be like a more limited money supply, but they wanted gold and silver and greenbacks. That'd be monetary expansion. It would be more inflationary, and it would help counteract some of the deflation that had been occurring up into those years, which was really harmful, especially to farmers, because they tended to be in debt. So if you are in debt, deflation means like the real value of your debt goes up. Inflation makes the real value of your debt go down. So farmers and other people in debt really wanted more inflation, and that's why William Jennings Bryan's Cross of Gold speech resonated with them so much.
Mhm. Yes. And from that topic, tell us about the gold standard and when the US stopped adopting it.
Um, yeah, so the US and a lot of the world were either on gold or bimetallic standard. Well, they would occasionally leave the gold standard for wartime, but really the US was on the gold standard until President Roosevelt took the country off the gold standard during the Great Depression. Um, so yeah, in the gold standard, like a dollar was defined in terms of a weight of gold. And dollars were redeemable for gold at a fixed rate. So you could always just convert a dollar into a fixed um, amount of gold. And when you have a gold standard, it constrains what monetary policymakers can do. They can't just really keep expanding the money supply, creating more dollars if there's not enough gold to back it. So that's why during the Great Recession, why eventually President Roosevelt decided to devalue the dollar, not be willing to convert the dollar to gold at that fixed rate anymore.
Mhm. I see. And tell us more about the greenbacks. So they were supporters of paper money, and you've made it quite clear in the book that the adoption of paper money carries risks of its own. So yeah, Tell us about that.
Yeah, so greenbacks came about during the Civil War in 1862. Congress passed the Legal Tender Act. The Legal Tender Act allowed Congress to issue treasury notes called greenbacks. And legal tender means like had to be accepted in payment of debts or taxes. So this was really controversial at the time. They were not sure whether it was even constitutional to issue this paper money. There was the argument kind of rested on the necessary and proper clause in the Constitution. So like the Constitution doesn't enumerate to Congress a power to issue bills of credit or to issue paper money, but it says Congress can do what's necessary and proper for filling out its enumerated powers. One of which is the national defense. So they were really debating about, well, is it actually necessary and proper to issue these greenbacks in order to be able to fight the war? And eventually decided, yes, that they were going to do it. But when the Civil War ended, I think most people thought of the greenbacks as something that was just a wartime measure, so just for emergency, and not something that they wanted to like keep relying on in the future. So in 1866, the Contraction Act says we're going to be withdrawing these greenbacks from circulation. And as they started withdrawing the greenbacks from circulation, of course, that's shrinking the money supply and leading to deflation, which was, again, pretty unpopular. So they kind of slowed down that withdrawal. And also there were a bunch of Supreme Court cases revisiting that issue of whether the greenbacks were even constitutional in the first place. Hepburn v. Griswold in 1869 said, no, they weren't constitutional because it was a violation of due process. But then there was kind of some turnover on the court, different group of justices heard the issue again the next year, and they overturned Hepburn v. Griswold and said, yes, the greenbacks were constitutional. And then even later, the case Juilliard v. Greenman authorized Congress to issue greenbacks even outside of wartime. So, so even though they weren't, even when we're not in a war, Congress can still issue paper money.
Mhm. Okay. So going back to the election of 1896, I understand that the years preceding that, the U.S. entered an economic crisis. We now call it the Panic of 1893. I believe it's the least known of the historical economic crises of U.S. history. And it was from the panic that the pre-silver movement gained a lot of traction. I think it lost steam when Bryan ran again in 1900, if I get it correctly. So what were the causes of the Panic of 1893?
The causes of the Panic of 1893, I'm not totally sure off the top of my head. That later part of the 19th century, though, there was basically a lot of deflation throughout it. But yeah, the Panic of 1893, I mean, like you said, it's one of the least known, and I don't remember the causes. But yeah, what happened in 1900? So, of course, you know that Bryan lost the election in 1896. The Gold Standard Act was passed in 1900, so that was formally committing the U.S. to the gold standard. But at the same time, there were basically new gold discoveries around that time that allowed that deflation that had been happening to reverse. So there was more like mild inflation in the early 1900s, and that kind of alleviated the feel that it was necessary for money expansion, because without that deflation, it didn't seem as urgent to be able to use greenbacks or free silver.
Yes. Tell us about the importance of a good monetary policy.
A good monetary policy, yeah, it's really important. So if you have good monetary policy, you don't really have to notice or think about monetary policy, right? But if there's not good monetary policy, then there's going to be a lot more volatility, a lot more inflation, uncertainty about inflation. There could be financial crises. There could be just more volatility and growth and in the labor market. So yeah, keeping prices relatively stable and kind of trying to, what monetary policy does ideally is it smooths out aggregate demand fluctuations and keeps aggregate demand growing pretty steadily. So yeah, it affects everyone, whatever the central bank does, right? Because interest rates and inflation affect everyone in an economy. There's no one who's like immune to monetary policy. So you can have a lot of also political and social instability when monetary policy is not done soundly.
Now, I would like to refer to two financial institutions that are prevalent in American life that I believe were controversial when it started, but now more or less has become acceptable. The first is a national bank. I believe it was the McCullough versus Maryland case that
Right.
decided in favor of a national bank, and it was Alexander Hamilton who uh, favored the establishment of one, and I suppose Jefferson was against it. So,
That's right.
what were the arguments behind the creation of the national bank?
Yeah, well, a national bank, like like I said about paper money, also, like the Constitution doesn't enumerate, it doesn't list out a power of Congress to establish a national bank. But it does have the necessary and proper clause. So Hamilton and the Federalists said, well, even though there's no enumerated power to create a national bank is still going to be necessary for allowing us to carry out our enumerated powers like collecting taxes, regulating interstate commerce, and providing for the common defense. So that was the Federalist view, that necessary and proper clause, that's Article 1, Section 8 of the Constitution. Jefferson and Madison, they were not convinced that it was actually necessary, and they thought that that was just such a broad and kind of overly expansive interpretation of the necessary and proper clause that if you interpreted the clause that way, you could basically have Congress doing almost anything. So they were worried about that precedent of interpreting the necessary and proper clause so broadly. Jefferson and Madison, they also tended to be like more in support of the small farmer, right? And Hamilton more as thought of as like support of commerce and finance. And so I think they were worried about what a national bank might mean for farmers, and that it would be kind of favoring making the US more of like a commercial society.
Well, the second financial institution is the Federal Reserve. It was created, I believe, during the Progressive era. The year was 1913. I think libertarians are people who are particularly have a particular dislike of the Federal Reserve, and I suppose you can tell us why or how it was created and
Yeah.
why libertarians seem to have a particular distaste for it.
Yeah, so a more well-known panic than the one you mentioned is the Panic of 1907. And after the Panic of 1907, that prompted the Aldrich Commission, which is also called the National Monetary Commission, to go kind of explore what were other countries doing as far as national banks or central banking, and what might the United States do to be able to have a more elastic currency, to avoid having so many financial panics, and to have a lender of last resort. So they Nelson Aldrich, a senator, and his commission went and did this big study, and they came up with their own recommendation for a plan of what kind of system they wanted the United States to have. That had to then go through Congress and be debated, and the House and the Senate had to reconcile their own versions of the plan. But eventually, in 1913, it passed the Federal Reserve Act. And because of all the compromises that were involved, the Federal Reserve has a pretty unique structure, right? We have like the Board of Governors in DC, and then we have the different regional Federal Reserve banks around the country. And part of that is because of like balancing interests between having some more centralized system versus a more decentralized system. Yeah, I think the libertarian view you're mentioning, like the abolish the Fed movement, that's about the idea that's usually associated with people who are in favor of returning to the gold standard. When the Fed was created, it did the US was on the gold standard, so the Fed's job was still to maintain the gold standard. But you could have a gold standard without a central bank in theory, right? And we did before the Federal Reserve Act. So I think that's the kind of like extreme view that you're thinking about. People who say, well, I want the market to, it's like the idea of like not leaving the money supply in the hands of the government institution, but leaving it to the market by saying the dollar is going to be worth a certain amount of gold, and then the market for gold would, and the supply of dollars would determine the price level.
Yes. I know that there's a running joke about how Ron Paul, the great libertarian, he kind of looks like the current Fed chairman, Jerome Powell.
Okay.
So it's a very funny thing.
I hadn't thought of that before, but okay, I could see it, I guess.
Um, Tell me about the current United States financial system.
The Federal Reserve System today, well, the one important difference from when the Fed was established, like I said, it was on the gold standard. Now, of course, it's not, but the Fed has evolved over the years in terms of its monetary policy framework and strategy. The kind of big official change that came in 2012 was when the Fed adopted an explicit inflation target. So since 2012, they've said we interpret price stability to mean inflation that's a PCE inflation that's around 2%. And then in 2020, they modified that to average inflation targeting, meaning if they undershoot that 2% target, then they'll try to make up for it by going over 2% for some amount of time. So price stability is one part of the Fed's mandate from Congress. The other part is maximum employment. So we call it the dual mandate. Yeah, but we still have, there's still the system where we have the Board of Governors in DC, and then we have the regional Federal Reserve banks. Members of both of those together, they make up the Federal Open Market Committee. So that has the 7 governors on the Board of Governors, and it has 5 of the different presidents. The governors are they are like nominated by the president of the US and confirmed by the Senate. The Reserve Bank presidents are not. So there's like, yeah, this kind of strange balance in there.
I've heard that the current US dollar is backed by fiat. What does that mean?
Yeah, fiat currency, that means that it's not backed by gold. Like when we were on the gold standard, a dollar was worth defined in terms of a certain amount of gold, and you could convert the dollar to gold at that fixed rate. Now, fiat is like because we say so, right? The dollar, it has value because everyone thinks that it has value, and it's also a legal tender, meaning like it has value partly because you know that you can use it to pay your taxes, and you know that other people can use it to pay their taxes. So people are willing to accept it in payment for goods and services. The value can fluctuate a lot.
Mhm. Yes. So I suppose the Civil War era greenbacks they won at the end because we are following their version of monetary policy at this point.
Yeah, that Juilliard versus Greenman case that I mentioned said like, yes, even though we're not, or even when we're not in a time of war, we can still have legal tender paper currency.
Mhm. Yes. Tell me about the causes as well as the remedies for the current era of inflation that I believe started in 2021 in the United States.
Yeah, so what's been kind of complicated and challenging for policymakers and for economists trying to interpret the recent years is that the pandemic really involved a combination of supply and demand shocks. The pandemic itself, of course, when people can't go to work, that's a big supply shock. People can't produce as much for all sorts of reasons. Um, and usually that tends to raise prices when there's an adverse supply shock. There was also an adverse demand shock, though, and those tend to reduce prices. That's when people at first, in the early stages of the pandemic, really couldn't go spend as much money because they were staying home. So that had this tendency to reduce prices, and we weren't sure like which effect would dominate. But so the government, fiscal policymakers and monetary policymakers took a bunch of different steps to address the harms that were coming from the pandemic. So there's big fiscal spending, fiscal stimulus packages, and a lot of monetary stimulus. And both of those boost aggregate demand. They help people be able to spend more. And that tends to increase inflation. But we still, it's still hard to tell like um, what's like the big drivers of inflation, demand or supply. So in 2021, there was a lot of demand because people were able to go start spending again, and they had a lot of money saved up from the stimulus checks, and interest rates were low. So there's a lot of spending from that. There was also, there continued to be like geopolitical issues and other things leading to more supply shocks. There was higher energy prices, some other commodity prices were rising. So yeah, by 2021, I mean, it was clear that inflation was really high. It was less clear how much of it was demand and how much of it was supply. And it was important to kind of distinguish those because if it was mostly supply driven, then that could possibly go away on its own as like supply issues resolved. If it was mostly demand driven, then we would need tighter monetary policy to address it. So yeah, the Fed, like looking back, they probably should have started raising interest rates a little earlier, which maybe would have kept inflation from getting as high as it did. They wouldn't have wanted to be like too much earlier or too much more aggressive because some of that was supply driven. So yeah, they were probably like a little late to the game, but not like, I don't think it was a terrible mistake. I think that they were just kind of being cautious. They didn't want to over tighten if it wasn't necessary.
Mhm. So did the Inflation Reduction Act of 2022 did its intended job?
Well, I mean, I think it's just a misnamed act. I think it had a lot of goals, but I don't think that reducing inflation was really
Oh,
one of the goals. I mean, one thing in the US, like we've delegated price stability to the Fed. The Fed is supposed to, you know, um, try to achieve price stability regardless of what fiscal policymakers do. So if fiscal policymakers do a big stimulus, then and that's going to cause inflation, then the Fed's supposed to counteract that. If they tighten and that's supposed to reduce inflation, then the Fed's supposed to counteract that. So it's almost nonsensical to call a fiscal policy or regulatory policy to call it something about inflation reduction. And a lot of what was in the bill really wouldn't clearly like have an effect on inflation, well, on reducing inflation anyway. So, I mean, there were environmental goals and other sorts of goals, which potentially the bill achieved. I'm not really sure. I haven't paid that close of attention to it. But no, I don't think the Inflation Reduction Act reduced inflation, but I don't think that's really what it was trying to do.
How does inflation connect with the national debt and budget deficit?
Yeah, so in different ways. I mean, when the government debt is really high, right, then that potentially makes it harder for the Fed to try to reduce inflation, because they know that high interest rates then are going to be like quite costly to the government's finances if there's a lot of debt. Also, like the process of creating that debt, it might have been contributing to inflationary pressures.
How did Lord Keynes's economic theories influence U.S. monetary policy?
Yeah, in a variety of ways. So I mean, partly there was the emphasis on using fiscal policy instead of monetary policy as the main tool of stabilization, and that became pretty influential. Like in the post-war years, I think there was more of a belief that like fiscal policy was the most effective way for the government to stabilize aggregate demand. And just the idea that the government should take a really active role in trying to stabilize demand was largely a part of the influence of Keynes. So a little bit later, like during and after the Korean War, I think there gradually became more of a recognition that monetary policy sometimes was what was needed. Like during the Korean War, when there was a lot of inflation, price controls weren't really a feasible option because they were like, there was not the political support for them. Fiscal policy couldn't really do anything to bring down inflation because fiscal policy was all about financing the war effort. So that really just left monetary policy. And so that's when the Fed got more independence from Treasury to be able to do monetary policy more as it saw fit. And that was, well, I've gotten a little bit away from your question about Keynes, but yeah, so I think he's still really influential, like the idea that you can have macroeconomic policy trying to smooth out fluctuations. But the idea that fiscal policy was more effective than monetary policy, that was influential for a time, but I think then became less so.
Before we move on, I think I'd like to ask you to explain the difference between fiscal and monetary policy.
Oh, sure. Yeah. So fiscal policy, that's policy from taxes and government spending. So fiscal policy, we leave in the hands of lawmakers who are elected. Monetary policy is what the Federal Reserve does, right? Interest rates and the money supply, and that there's more argument for kind of insulating that from politics. Because fiscal policy, the taxes and spending, can have much more direct distributional effects. So you might raise taxes on some people, but not on others. You might spend on particular types of social programs, spending projects that help certain groups in the economy. So it's much more like interest group oriented. So it's really something that needs to be voted on, or at least done by people who are subject to elections. Monetary policy is usually thought of as kind of more technocratic, more like justifiable to give it some independence. Yeah, but when we're talking about what the Fed does, the Fed is supposed to do monetary policy. Congress passes and the president signs fiscal policy.
Yeah, I hear that Milton Friedman was described as a monetarist. Does that mean that he favors a more sound monetary policy?
So he really believed that monetary policy mattered. He looked at monetary aggregates, like different measures of the money supply, and saw them as being really important for explaining what was going on in the economy. He, as far as monetary policy preferences, he was an advocate of what was called the K% rule, where he thought you should just have the money supply growing at some fixed K% per year. That never really caught on. Now the Fed doesn't focus as much on monetary aggregates, rather focuses on interest rates. But the idea of like some sort of rules-based policy was something that that he was in favor of.
Okay, right. So I noticed there's a pattern in your book is that in times of war and times of economic crises, the role of the government seems to get more enlarged.
Mhm.
So I'd like to focus first on wars. So what are some of the ways in which the government becomes more larger and more activistic during wartime?
Yeah, so in major wars, I mean, there's more of a need for government financing. They need to finance the war effort, they need to finance their military expenditures, and you can finance expenditures by borrowing money or taxing or printing money, and they usually do some combination of those. And any of those mean like the government is going to be kind of growing. Government spending is going to be accounting for a larger share of economic activity. They're going to be trying to mobilize different sectors of the economy to be part of the war effort. There's usually more popular support for that during a war because people will agree that this is something that needs to be done, that it's an emergency, that even if there's some costs, like even if some of what's being done isn't something that we would think of as being legitimate in normal times, it has more legitimacy during a wartime. But then some of that, so like the growth of the state that happens doesn't always totally get like rolled back when the war is over. New administrative agencies are created, more people start working for the government. Just a bigger state is not always that like susceptible to just shrinking back down to where it was.
Mhm. I believe it was either Friedman or Thomas Sowell who says that there's nothing more permanent than a temporary government program. So,
Yeah, I'm not sure who said that, but it could be one of them.
so I wonder, has there been a precedent in which something that was created in wartime becomes rolled back after a war?
I mean, sometimes the World War II price and wage controls, well, the price and wage controls in World War I and II were eventually rolled back. So not all were rolled back immediately, but yes, I think people they were willing to have price controls and to comply with price controls during the war when they saw it as really necessary. But after the war, they started to more focus on the problems with the price controls. People got really upset when there were shortages of beef because there were price controls on beef, which means there's going to be shortages, and that really angered consumers, and eventually the price controls did have to be rolled back.
So I've studied an economic course back last year, and I know that price controls or wage control includes a ceiling and a floor. So I suppose minimum wage would be a form of wage control, and rent control would be a sort of a price control also. Um, so yeah, and I know that in the 2016 as well as the 2020 election, Senator Bernie Sanders from Vermont brought up the topic of rent control quite recurringly. So I'd like to hear your thoughts on to what extent is well, first, rent control, is that effective?
So yeah, a rent control is a form of price control. A wage control is a form of price control. The wage is the price of labor. The rent would be the price of like a housing service. So yeah, and like you said, controls can be the form of a floor or a ceiling. And a lot of the wartime price controls I've talked about have been price ceilings, right, intended to not let prices rise. But sometimes there have been price floors, often for like different kinds of agricultural goods, often as a form of like protection when farmers would say like, oh, the price of my crop is like falling so low because foreign competitors are selling things too cheaply. I want there to be a price floor to like keep prices up. So that's also a form of price control. I think what Sanders has in mind is a rent ceiling, right? Slowing down or stopping rent prices from increasing. The trouble with any kind of price ceiling is then there's going to be scarcity because you're imposing a price that's lower than what people are willing to pay. So there's going to be people who say, well, I'm willing to pay that price, but there's just none available at that price. So, I mean, I think more effective at keeping housing costs from getting too high is like regulatory reforms that would allow more supply.
Mhm. And of course, the other one is a minimum wage. I believe one of the products of the progressive era is also the imposition of a federal minimum wage.
Right.
And correct me if I'm wrong, but it sits somewhere between 750 and 850 per hour.
I'm not sure exactly what the federal minimum wage is right now.
Okay. But so tell me about how the federal minimum wage was established.
Um, yeah, I mean, again, is the like a progressive era idea, and at first, minimum wages were not proposed like for everyone, but there was like proposals to do a minimum wage just for women because they were more like there was more chance of them being exploited. And yeah, there were different like kind of laws establishing either minimum wages or maximum hours that could be worked in various industries, and those all had to like come be questioned in the courts to see if if the courts would uphold them as constitutional or not, because when you establish minimum wage or a maximum number of hours, you're interfering with the ability of two parties to make a contract. Someone might want to work for $6 an hour, and the company wants to hire them for $6 an hour, and they would like to make a contract, but then the government is saying, no, you're not allowed to make that contract. So the courts had to, say agree when that was constitutional.
Okay. So what was it? Tell me about. Oh, I just found out about the federal minimum wage is 7.25 an hour.
Okay.
Um, Tell me about how economic crises they often expand the role of the federal government.
Yeah, I mean, economic crises are like similar to wars when there's something that's seen as an emergency, and that getting through this crisis or getting through this emergency is the top priority. it kind of focuses everyone on the similar goal. Like, we need to win the war. We need to get through this pandemic. We need to get through this emergency. With everyone focused on the same goal, it becomes easier to like get, either pass bills or get make emergency declarations, different kinds of actions that might be a lot harder to get done in normal times when people are not all focused on the same thing.
And speaking of, I wonder, did the U.S. Successfully got through the 2008 and 2009 financial recession?
Did we successfully get through it? I mean, I think
Your
that
opinions, yes.
there were parts that were a success. There were parts that weren't. So the Fed chair, Ben Bernanke, he was a scholar of the Great Depression earlier in his career. And he kind of famously made a statement about the Fed and the Great Depression where he said, like, we did it, we're sorry, we won't do it again, or something along those lines. And yeah, to a large extent, yeah, there was not another Great Depression in 2008. Unemployment was very high, but it was nowhere near like 25% unemployment rate faced during the Great Depression. The recession was painful. It was the recovery was quite slow, but it really but there was a recovery, right? The official end date of the recession was not that long, but then just afterwards the recovery was very slow. So unemployment just like gradually fell. So maybe maybe the Fed could have done better to get a quicker recovery, but I don't think it was a total failure, right? It could have been a lot worse too.
Right. Speaking of economic recession, I understand that within the field of economic history, there's still a debate as to what caused the uh, Great Depression of 1929 and 33. So give us an overview of what the parties of that debate are.
Of what the parties of that debate?
Yeah,
Right,
as in what caused the
different
Great
theories.
Depression? Like what is the argument essentially?
Yeah, I mean, there's arguments about like, well, there was the stock market crash and banking crisis. Like, was that actually the cause, or was that a symptom of some other cause? And probably it was a symptom of other causes. Then there's I think a large part of the debate is like, how much was the Fed to blame? Did they overly tighten monetary policy? Was the gold standard itself to blame, right? Could they have done better without the gold standard? Or was it not that the gold standard was to blame, but that kind of mismanagement of the gold standard? The Great Depression, it's important to remember, was international. The economies around the world were all linked by the gold standard. So that means that like policy really was linked across the countries, and in a way that could kind of amplify the Great Depression. So like, if your trading partners are having recessions, then that hurts your own economy. And these international linkages helped kind of spread and deepen the depression too. There's also a lot of debate about like, what was the role, what caused the recovery, and what was the role of Roosevelt's New Deal in helping the recovery along or not. That's another big debate.
Mhm. Yes. Before we move on, I checked that the temporary government program quote is attributed to Friedman. So,
Okay.
yeah. So for the what ended the Great Depression? So are you a so are you an advocate of the New Deal program that helped the economy, or are you in favor of the U.S. entered the war and that helped mobilize the economy for the better? Can.
Well, I would say neither really. Even when the Great Depression ended, is not that clear. I mean, some people would say it ended with World War II, but there was really like it's called a double dip recession. Like there was a lot of recovery in 1933, 1934, then another decline in around 1936, 37. So yeah, I think that that recovery that came in 1933, 34, that was when there was more monetary expansion, right? The deflation was able to be combated, reflation started happening. I don't think that the New Deal programs played a really big role in contributing to the recovery. I would point you to George Selgin has a book that goes in a lot more detail about the New Deal and the recovery from the Great Depression.
Mhm. Yeah, tell us about the author and the book title again.
George Selgin, let me look up the title real quick. It's called False Dawn, the New Deal, hold on. The New Deal and the Promise of Recovery.
Okay, wonderful. So allow me to move forward a few decades from the 1930s and into the 1970s. Tell me about the stagflation that occurred during that era.
Yeah, so stagflation is the combination of high inflation and high unemployment, which is different than the high inflation we had recently, which went along with a pretty strong labor market and low unemployment. So step back a little bit, during much of the 1950s, monetary policy was like working pretty well. There was relatively low inflation, and the Fed was kind of behaving like we would sort of expect a modern central bank to behave. In the 1960s, Milton Friedman started kind of warning people that the Fed was allowing the money supply to grow too quickly. It was like sowing the seeds of inflation. And the Fed later in the 60s and throughout the 70s followed what's often called stop-go monetary policy. So they would kind of put on the brakes for a while, trying to tighten up monetary policy, slow down the growth of the money supply, try to bring inflation under control. But then they would be discouraged in that effort because unemployment would be rising, and they would stop, and they weren't so they didn't have any credibility for fighting inflation, and they would like fight it for a while, give up. And Chairman Arthur Burns, who was appointed by Nixon, he really didn't even think that monetary policy could control the inflation. He advocated for price and wage controls, and thought that once we had that, that was really what was needed. So monetary policy wasn't really used to bring down inflation until the Volcker disinflation of the early 1980s.
Yeah. Tell me about how Paul Volcker changed the Fed.
Well, Paul Volcker really, it's called the Volcker disinflation, when he really just committed to bringing down inflation even at very high cost. So there was a very severe recession and a lot of pain that came from bringing down inflation. But he thought it was really important for the Fed to get this credibility, this reputation as being an inflation fighter, and that once the Fed had that kind of credibility, then in the future it could be less painful to try to bring inflation under control. He was he was reluctant to do well, and so was his successor Greenspan, reluctant to like officially adopt an inflation target like the Fed has now. So it was really just on the strength of his like personal reputation that that people believed that the Fed would stabilize inflation.
Yes. I wonder, would a Volckerite monetary policy be applicable to today's inflation balloon?
Well, Chairman Powell did kind of directly compare himself to Volcker when like in 2021 or 2022. I think a lot of what he said about like the Fed's promising to bring inflation down and making that their number one priority was really drawing on those lessons from Paul Volcker. I think, yeah, all central bankers to probably a pretty major degree are really influenced by that episode. They probably just see it as a demonstration that monetary policy does matter and that like sticking to your plan matters. So
Mhm. Yeah. What is modern monetary theory?
that might take more than the remaining 5 minutes to
Well,
get into. It's a kind of group of people have this idea of how the economy works that's pretty different from mainstream, but I think involves a lot more of a blurring of the lines between monetary and fiscal policy. It yeah, it's a little hard to define exactly what it is that they believe. So I think I'd rather not try to get into the details and misspeak.
okay. Well, I suppose in what ways have it impacted how U.S. monetary policy is being run?
I don't think it's influenced how US monetary policy is being run. It's still kind of a fringe movement.
Okay. Um, so two final queries. So is inflation or expanding the money supply a good way to solve an economic recession, or it's just a way to prolong it?
Well, it depends on what like recessions are all different. It depends on what the cause is. So in something like the Great Recession, which was a big adverse demand shock, it is appropriate for there to be aggregate demand stimulus, which means looser monetary policy. If there's a recession caused by like an oil price shock, then looser monetary policy boosting aggregate demand wouldn't be helpful and could be harmful in that circumstance. So it's not always clear cut, like what the cause of a particular recession is, but yeah, monetary policy is a tool for stabilizing aggregate demand. So it can only be effective in recessions that are primarily a lack of aggregate demand.
Finally, do you take much stock on the paradox of thrift, saying that what is the value of thrift as an individual, as a household economy, is not applicable to the national economy?
Hmm. I haven't thought that much about the paradox of thrift since learning about it in grad school. I mean, yeah, personally, I try to be thrifty, and I think that it's a good thing if people have enough savings to cushion themselves. When a lot of households were like highly over leveraged before the Great Recession, that made it that I think made the recession a lot harder and made it just harder to recover from. So yeah, I think there's definitely big benefits to having households be able to save and to have a good supply of savings.
I think that's a good way to end. Thank you very much, Carola Binder of
Thank you.
Haverford College, for joining the show.
Yep, nice to talk to you.